Hello everybody, this is Lara with your end of the week video for the S&P 500 for the trading week ending Friday 26th of June 2020. I am expecting that this big multi-week bounce is now fairly likely to be over, and I'm expecting downward movement to resume and to increase with strength. A midterm target is at 2723. The last gap that forms the new abandoned baby pattern may provide resistance at 3127.12. I'm expecting a sustainable high may now be in place for the 8th of June, and my lower targets remain quite bearish. I do have a bullish alternate. I will consider that possibility. We should always consider all possibilities if they are valid. This is the main wave count, which has support from classic technical analysis. This wave count sees the huge bull market, which began in March 2009 as the simplest Elliott wave structure, a 5-step forward pattern. 1 and 2 are off to the left of the chart. Here's the end of 3 and 4 and 5. And then it sees a 3-step back pattern to follow that 5 steps forward. That's the simplest Elliott wave pattern. 5 steps forward, 3 steps back. The 3 steps back on this chart is labelled Cycle Wave 2, and it will subdivide at primary degree A, B, C. Cycle Wave 2 can be any corrective structure except a triangle. It's most likely to be a zigzag, and so far that looks like how it's unfolding. A zigzag subdivides 5, 3, 5. It's labelled ABC, and it's the simplest Elliott wave corrective structure, and that's the most common corrective structure for a second wave. Within a zigzag, B may not move beyond the start of A. C would be expected to move below the end of A to avoid a truncation. I have 2 targets for this zigzag to end, and this is how I'll approach them. As price approaches the first target, if the structure of primary C is incomplete or price just keeps on falling, then attention will turn to the second target. And if price approaches the first target and the structure could be complete, we'll look out for technical indications of a sustainable low in place. Let's take a look at the daily chart now, where the high of cycle wave 1 is this point here. Now we're looking at the detail of cycle wave 2 as a zigzag A, B, C. It looks like B is over. It subdivides very nicely as a completed zigzag, the most common corrective structure, labelled ABC, which subdivides 5, 3, 5. If B is over and C has begun, then so far there may be intermediate 1 and 2 complete within C, and intermediate 3 may have just begun. If this is correct, then intermediate 3 as a third wave within a C wave could exhibit quite a lot of downward strength. Look out for surprises to the downside if my short-term analysis is wrong in the future, in the next few weeks. If intermediate 2 is over here and intermediate 3 has begun, then I'm going to label minor wave 1 within it incomplete. I think it would be too short to label it over here. When minor wave 1 may be a complete structure, then a bounce for a few days, if not a couple of weeks or so, may be expected for minor wave 2, which may not move beyond the start of 1 above the invalidation point. I'm showing these gaps, the price points for these last 2 gaps on this chart, because they're important in terms of classic technical analysis. There's an island reversal here, and the island reversal will remain a bearish signal while this gap here remains open, and so while price does not move above this price point. And now, after this little rise, there's an abandoned baby. This is a really rare reversal pattern. And this will remain a valid bearish signal while price leaves the gap, while the gap remains open and price doesn't make a new high above this price point. And so we can use these gaps as resistance areas for this analysis. I have more confidence in the island reversal than I do in the abandoned baby, though, because the abandoned baby could be viewed within the context of a consolidation rather than the context of an upward movement. It's an upward swing for sure. Okay, so I'm going to leave the invalidation point up here because minor wave 2 is yet to come. For now, within minor wave 1, minute 1 and 2 could be complete, and minute 3 may show an increase in downward momentum next week, and then minute 4 may not move into minute 1 price territory, and then a final fifth wave down. So a 5-step pattern, 1, 2, 3, 4, 5, may continue downward next week. At the hourly chart level, here's the end of intermediate wave 2 and the start of intermediate 3 with minute 1, 2 and 3 to complete, with minuet 1 and 2 and 3 to complete, with 1 and 2 and 3 to complete, so an overlapping series of first and second waves. So we may be expecting an increase in downward momentum next week. Within minuet 3, if this subminuet 2 is yet to begin and unfold, it may not move beyond the start of 1 above the short-term invalidation point. At the daily chart level, this wave count is an alternate. All the subdivisions are exactly the same. The invalidation point's the same. The targets are different, and this final confirmation point is important. This wave count moves the degree of labelling within the entirety of that bull market from March 2009 to February 2020, all up 1 degree. Instead of just a first wave within a fifth wave, if that whole fifth wave is over, then there could have been a trend change at grand supercycle degree in February 2020. That's a once in multi-generations trend change and the start of an absolutely huge bear market. This is an extremely bearish wave count, which would expect a new low below this price point is very likely. That's a long way away though, and we're not going to know if this is the correct count or the first daily chart is correct until we see a new low below this price point. Up to that point, both of them will remain valid. This wave count expects an enormous bear market to be labelled Grand Supercycle Wave 2, probably to subdivide as a zigzag, but it could be any corrective structure except a triangle. If it's a zigzag, which by a fairly wide margin is the most common Elliott wave structure, particularly for a bear market, then A should subdivide as a 5, and so far 1 and 2 would be complete, and now 3 beginning, with 1 and 2 complete within primary 1. Within an intermediate 3, no second wave correction may move beyond the start of its first wave. Eventually, when primary wave 1 would be complete, this wave count would then expect a big multi-week bounce for primary wave 2, and at that stage the invalidation point will move all the way back up to here at the daily chart level. We're not there yet though, that's weeks away. At the hourly chart level, the subdivisions are the same. This wave count looks essentially the same as the first chart, which I've already gone over, so I won't waste time on that one again. This is an alternate wave count that is very bullish. This wave count considers the possibility, what if the S&P is on to make new all-time highs? This wave count is quite different at the monthly chart level. It sees the huge bull market quite differently. To view the differences, please view the monthly charts. I link back to my monthly charts at the beginning of every Lara's Weekly and every daily analysis for S&P 500 members. If the S&P is in a new bull market, then we may have a first wave up here, a brief and shallow second wave, a third wave which is shorter than the first wave, a fourth wave could be over here, but it could be continuing sideways as some kind of combination or triangle. It may not move into wave 1 price territory below the invalidation point. If the fifth wave has begun here, there may be 1 and 2, a third wave up may begin next week, and then 4 and 5. Intermediate 3 here is shorter than intermediate wave 1, which means intermediate 5 is limited to no longer than equality in length with 3 at this price point. So the intermediate wave 3 is not the shortest actionary wave, and that core Elliott wave rule is met. Draw a trend channel around this from 1 to 3 with a copy on 2. It perfectly showed where 4 found support and bounced up, but prices closed below the lower edge of this channel. This is not a proper breach though. I define a breach as a full candlestick below and not touching. We don't have that yet. We may get that early next week. Now, it is also possible to move the degree of labelling within intermediate 3 down 1 degree. This could just be minor wave 1 within intermediate 3, and then minor 2 may continue lower. The invalidation point for that idea is down here, but I'm not going to publish it that way because it just wouldn't fit at all within a channel. The S&P doesn't always fit nicely within channels, but it just doesn't look right. And I consider the possibility, but I may not publish it, and I may discard a bullish wave count if we get movement below this invalidation point. The final target is for cycle 5 to reach 2.618, the length of cycle 1 at 3640. This wave count is very bullish, and it expects the bull market to continue for another several months, maybe even a year or two. At the weekly chart level, this week completes a reasonably bearish candlestick. The long upper wick is bearish. The close near lows for the week is quite bearish. Price fell of its own weight overall, but when we look at the daily chart, we'll see something quite surprisingly bearish. On balance volume has a new short-term range. If a breakout of this range would be a signal either way. Support about 3,000 is still holding. We need to break below that important support level for a more bearish outlook to have further confidence in it. RSI is neutral. There was some quite long-term bearish divergence between price and RSI at these highs. It could possibly have been resolved from this big downward movement though. When I get to the daily chart, this breakaway gap isn't going to be very clear because it's been overlaid by the notation for the moving averages, but this breakaway gap remains open, and that's important. Breakaway gaps should remain open while the resulting trend that follows them is underway. And so while this gap remains open, the conclusion is that the trend that results from the gap may still be in place. If the gap is closed, then the trend resulting from it may then be complete, and that would be quite a bullish signal. The fact that this gap still remains open is still a bearish signal. ADX is declining after just reaching extreme for that downward trend. At this time frame, there's no clear trend. It hasn't caught up with that upward bounce. MACD is bullish and ATR declining and overall flat as price is moving sideways and higher. At the daily chart level, we've got quite a few 80 and 90% upward days here. We've got an 80% day here, and then we've got a 90% up day and an 80% up day back to back. So that meets the requirement of, well, two requirements of either a 90% or two back-to-back 80% up days to be bullish, but it was followed within 3 sessions by a very, very strong 90% down day. That represents a 180-degree shift in sentiment from fully bullish to fully bearish, and that's a normal thing to see around a pivot. We saw it back down here, a 90% down day followed quite closely by a 90% up day and an 80% up day, forming this V bottom, and that was one thing that gave me confidence back down here that we had a sustainable low in place. We may have a sustainable high in place now. We also have this island reversal pattern. While this gap remains open, the island reversal will remain a bearish candlestick pattern. Now we may have an abandoned baby pattern as well. While this gap remains open, the abandoned baby pattern, well, it is an abandoned baby, it's just what context are we viewing it in as to how bearish is it. If we view it in the context of a consolidation, then it's not really a particularly bearish signal. But if we view it in the context of coming at the end of this little rise, then it is a bit more bearish. While this gap remains open, it will remain a bearish signal. The island reversal is more important though, and if this gap is closed, that's not necessarily overly bullish. I would definitely be expecting resistance at the low of this candlestick though. If this gap is closed, then the analysis would necessarily shift to a much more bullish outlook. While it remains open, the island reversal remains intact, and I'll have a bearish outlook, at least for the short term. Friday was a pretty strong downward day, and when I look deeper into this and look at small, mid and large caps, it was mid caps that dominated volume in downward movement for Friday's session. It looks like a very strong downward day, and prices closed quite close to lows for the session, which is bearish. I'd be expecting that to be followed by more downward movement next week. ADX is declining, the DX lines are whipsawing, there is no clear trend at this time frame. ATR is flat as prices essentially range bound. When it breaks out, then I'll expect ATR to increase. This resistance line now has good technical significance. It has several tests, it's close to horizontal, and for the daily chart, it's reasonably long held. A move down here is another bearish signal. If on-balance volume comes back up to this trend line, I would expect it to find resistance and for that to assist to halt a rise in price. RSI is neutral, plenty of room for price to rise or fall. MACD bearish, and stochastics in neutral territory. Using the AD line as a measure of market breadth, this week there's a little bearish signal. The AD line has made a new short-term low. Price hasn't managed to make a corresponding low. Downward movement in price comes with declining market breadth. Breadth is declining a little faster here than price, so that's a bearish signal. We see it here at the daily chart level. Price has not managed to make a new low this week below this price swing low here, but the AD line has. The decline in price is coming with a decline in market breadth, which is bearish. Inverted VIX isn't quite so clear at the short term. Price has essentially completed an inside week. Inverted VIX has slightly increased. Price ended the week quite strongly with downward movement, but overall for the week, inverted VIX has slightly increased. But inverted VIX does remain well off its previous all-time highs, whereas price back here was making new all-time highs. This swing high here compared to this same point for price is not too far off its highs, but inverted VIX is a lot lower. VIX does remain quite elevated, volatility does remain high, which is overall bearish. It's a little harder to read that one, it's inverted VIX. At the daily chart level though, slight cause for concern. We do have this cluster of short-term bullish signals from inverted VIX. Price is making new lows for the short term, inverted VIX is not. Price is having a downward day, inverted VIX is moving higher on these days with the arrows. So for the very short term, a little bit of concern, but when we look at the bigger picture for VIX, it does still have that really strong and long-term bearish divergence. So overall, I'd read it more bearish than bullish. That's all from me this week with your S&P analysis. I hope all our members are having an awesome weekend.